Let's get started one more time. Welcome, traders. I'm happy and excited to see every single one of you here on our first webinar on the series of 7 webinars and our ADAS marathon. My name is Anastasia. I'm a professional trader with 8 years of experience in the markets, specializing in volume analysis and order flow trading. Over the years, I have taught thousands of different people, different traders with the different levels of expertise, how to use volume effectively in decision making, and I do work daily with the most advanced analysis tools as a part of the ARAS team. And my goal today is to show you how to see the markets through the logic of big major players and how to use the tool that we're going to be talking about today in a moment to find strong trading opportunities. Okay, so everything we will be discussing today has been tested in practice. So I want you to know this is a practice applicable knowledge, and I will help you to improve the quality of your trades as much as I can during today's 60 minutes of webinar. So I'm excited and happy to see everyone here, and thank you for everyone who's been with us since our first webinar 4 weeks ago. Imagine it's been 4 weeks since we see each other here weekly on Tuesdays, and I'm also excited and very special welcome to every single one of you who is joining us for the first time today. And as usual, let's quickly check the connection before we're going to get started and dive into the topic. Just can you please put a plus in the chat if you can hear me and see me clearly? That would be really helpful to have some feedback from you. Can you just put a plus in the chat if you can hear and see me clearly? Amazing. I do see some pluses, swirls. Nemsa Paul is here. Fantastic. Saeed is here. Thank you so much. Dmitry, Milana, Nicholas, Tuha, good to see you, everyone. Fantastic. Thank you so much for your feedback. Lovely feedback, lovely activity. I'm really happy to see every single one of you here. And let's quickly recap what we covered in our previous sessions before we're going to dive into our today's topic. Okay, so in our first webinar, we discussed the mechanics of price formation through orders. And we were talking about the market auction theory and how the price is formed. We also covered that market orders move the price and limit orders act like a wall and they stop the price from moving. And every time you see the price stopping in the market and stops the movement is because there is a wall of potential limit orders standing there and absorbing the market activity. In our second webinar, however, we also talked about the logic of bid and ask, and we covered the aggressive impairs order flow. In the third webinar, we were talking about vertical volume, and that was our previous webinar last week, and we talked about how it's related to price movement and clusters. We also covered different trading setups that you can already use into practice, apply into practice, and if you already had a chance applying anything from the first 3 webinars and you have some feedback, please post it in the comments. I'm going to be very glad to see how it turned out to be for you. Today, however, we will be diving deep into our new powerful analysis tool, the one that I personally use every single day in my trading. There is not even a single trading session or any trade decision that I make without relying on this very tool. Okay, so this is a very important part of my trading routine. So can you please let me know in the chat if you can guess which kind of tool is this? Can you guess what are we going to be talking about today? Again, this tool is absolute necessity in my trading practice. And I do not make any trading decision. I don't open any position in the market without this very tool. Exactly. Yes. This is the horizontal volume or the volume profile. Nemsa Paul. And yes, you got it right. Fantastic. So we're going to talk about volume profile, the horizontal volume. And the question for you now is, who has already heard about volume profile? Can you please put 1 in the chat if you have already had experience with volume profile, or if you had at least heard about it before, and can you please put 0 in the chat if this is the first time you're going to be hearing about volume profile and you've never had any experience with this tool. 1 if you did have some experience and if you heard about it, and 0 if this is the first time we're going to be covering it together. Nice. I do see a lot of 111s. Heard about it but never used it. That's also good. Okay, Milana says 0. Okay, good. Alexander says 0. We have a couple of zeros. We do have lots of ones. Okay, perfect. This is very good because today we're going to be diving also from the beginning and the basis of the tool into 3 different base setups that you can build your trading system upon. Okay, and we're going to talk also the combination with volume profile and the footprint charts, and we're going to have some examples in practice as well. So just before we're going to dive into the topic, just a quick reminder, if you have any questions during today's webinar, in the end of the webinar, there will be a special Q&A session that you will be able to ask any questions of. So if you have any questions, you can either type them in the chat immediately, or you can keep them until the end of the session. And then I'm going to be able to come back and answer all your questions throughout. Okay, so because then we're going to keep it structured. So let's get started. Okay, there we go. So the webinar 4 out of 7, and we're going to be talking about horizontal volume, which is going to be helping us to identify areas of interest for big market players. So let's quickly revisit a couple of key points from our earlier webinars because they will have a direct connection to the topic of today. First things first, what is volume and how is it calculated? This is something that we covered last week, and I want to just remind you and everyone who is joining us for the first time. We already know that volume equals ask plus bid. In other words, it's a summary of all orders that were executed in the market, including stop losses and take profits. Because if we talk about derivatives and futures markets, the take profit and stop loss orders also calculate as a separate order, and they are a part of the total volume calculation. So, okay, the volume formula is ask plus bid. If you already know this, great. If you don't, this is a good moment to make some notes. Next, with this understanding, in our last webinar a week ago, we studied the vertical volume indicator and trading methods based on it. So let's quickly recall, what does vertical volume show? The vertical volume is the indicator that you can see in front of you on the screenshot on the bottom of the chart. So vertical volume in the schematic representation shows how many trades occurred over a period of time. For example, in 1 minute, 5 minutes, 1 hour, day, week, etc., etc. So in other words, vertical volume is time-based volume because it's based on the Japanese candlesticks and the period of time that it takes for the candle to form. Okay, so how is it different from the horizontal volume, which is the topic of today's webinar? Well, the horizontal volume shows how many trades occurred at each price level, regardless of time. It is a price-based volume, and it helps tracking market participants' interest at each specific price level. You can imagine it this way. If vertical volume is loudness over a minute, then horizontal volume is loudness at a specific price. So on the chart, the volume profile looks like a histogram on the side of your chart or on the chart itself, depending which tool you use and how you place it. The logic is the following. The wider the histogram, the more volume was traded at that price level or price zone. In ATAS, this is built automatically. Over the selected time range, the platform calculates which prices had the highest volume traded. This is very important because large players, like for example funds, institutions, market makers, They do not jump into the market randomly. They build their positions around specific prices that are convenient for them. So the volume profile shows us these zones of interest. Let's quickly summarize the basis of the volume profile. The wider the histogram at a particular zone, the more trades were traded at that specific level, meaning the more money was invested there. Now, thinking back to our first webinar of the series and to the order book or the depths of market, we can logically assume that at the zones with high volume, there will be a limit buy orders and sell limit orders left, which means that in the future, these levels can act as a support or resistance zones. And price often reacts to the zones of increased volume. It's exactly the concept that we will be later building as a foundation of our trading system. And can you please drop a plus sign in the chat if everything is clear so far? If you understood everything that we just covered, can you please drop a plus and we're gonna move on. Okay, just want to see if so far it's been clear. Okay, perfect. Thank you so much. Thank you for your feedback in the chat. I love the interaction going. Thank you so much. Okay, so each volume profile histogram has elements that it consists from. And you can also call them the key zones of volume profile or the key elements of volume profile. And you can see right now all of them on the chart in front of you. I especially highlighted and named every single one of you to make it easier. Now let's break them down one by one and what do they mean for us as traders. First of all, the value area. Value area, which literally means the area of the value, is the darker shade area of the volume profile histogram that by default covers 70% of the total trading volume over a specific period of time that you choose. The upper boundary of the value area, as you can see, the upper line where the darker area finishes, this is called the value area high, or abbreviated VAH, and the lower boundary, the value area low, abbreviated as VAL. Those are two key levels marking the range where the majority of trades took place. The percentage of the value area can be adjusted by manually if you wish so, but personally, when I use a volume profile, I leave it as a default setting of 70%. This also automatically means that 30% of the total traded volume during this period that you choose was traded outside of the value area. To visualize it clearly, you can imagine that over a certain period, like for example, over the move to the upside that you can see in front of you on the chart, there were 100,000 contracts traded. Okay, imagine from the bottom to the top of the move, 100,000 contracts in total. In this case, 70,000 contracts would have been traded within the dark area, which is the value area. And the remaining 30,000 contracts would be traded outside of the value area, above and below it, where the histogram is a little lighter. Okay, so it's important to know that price often reacts of the boundaries of the value area. So the upper and lower boundaries, which is value area high and value area low, can often react and act as support and resistance levels. Some traders even use these tools in their trading to find entry and exit points, and we will be covering it more in details later in our webinar. So that was the key element of volume profile number one. Now we are going to the next one. And next component is the volume extremes, also known as high volume nodes, abbreviated as HVN, high volume node. Okay, these are the zones of maximum volume accumulation on the volume profile histogram. Sometimes, over the selected period of time that you choose yourself, there are several high volume nodes, and sometimes there is only one. The example that you can see in front of you has one biggest high volume node, one big extreme, and four other smaller ones, one above and three below the major volume area. It's the larger volume, which is very important. Now, the thing that I'm going to say next is extremely important, and I want you to immediately make some notes on this. The largest volume is often traded and accumulated during periods of consolidation. It's precisely the small price fluctuations, the smallest price movements in the market, that lead to the largest volume accumulation and formation of the largest high volume nodes. It's because when price moves in the range or moves slowly, it usually means the active accumulation is taking place in that zone. We will use this fact in our trading, since volume accumulation plays a very important role in market dynamics, and this is the fact that will become a foundation for at least one of our trading methods. Next, the point of control, the king, as properly referred as the POC. This is the main level where the highest number of contracts, lots or auctions, right, depending on the market that you trade, was traded during selected period of time. So again, if we consider this whole histogram from the bottom to the top, that there were 100,000 contracts traded, on the red line that you see in front of you, this line will be characterized as the most amount of contracts was traded there, or in other words, the maximum amount of money was invested in the market at this specific level. You can also say that the highest interest of market participants was exactly at this price level. On the volume profile histogram, this level is displayed as a bright, bold line. You can adjust the settings in your ADAS platform however you want it to be visualized. You can change their color, for example, but I like to make it bright, so I'm definitely not missing out on this specific level because it plays such an important role. As you can see on the screenshot in front of you, price often reacts to the point of control. It's usually also referred as the maximum volume level for the reasons that we just talked about, and it is a key reference point for analyzing market structure and for identifying both entries and exit points for your trades. We will be actively using the point of control in our trading as well, and we're going to be talking about the trading method using the point of control later in our webinar. And finally, the last one, vacuum, or in other words, the imbalance. This is an area of the minimal volume. As you can see, I highlighted two zones of the histogram of volume profile where volume was dropping and the histogram became narrow and narrow each time. This is the area of the minimal volume traded during the selected period of time, and it often forms as a result of sharp price movement, right? That is a paradox and the irony of the market. The smallest price movement creates usually the highest volume accumulation. The biggest movement of the price, like for example, the first vacuum, you can see the market made a spike. It jumped, it made a very fast move to the upside, although this move required the smallest possible volume. On the volume profile, the vacuum appears as a zone where price moved quickly with a very few trades executed. This indicates a disbalance between buyers and sellers, and if price rises sharply, it means that aggressive buyers were dominating, not allowing the market to form a significant volume, and there was also no limit orders wall anywhere to stop the price. If the price would fall sharply, on the other hand, this would mean that aggressive sellers were dominating the market at that very moment. Such zones often react and act like magnets, pulling the price back as the market may return to them later to test the liquidity. I also like calling the imbalances of vacuum as a black hole of the market. It's like nothing is there, there is no volume, but it attracts the price, and price usually goes there like towards a big magnet that is pulling the price towards it. I hope this reference can help you also to identify it and memorize it when you will see such thing occurring when you will be actively trading live. So coming back to our all components of volume profile histogram, the obvious question is, why does a trader need all this point of control, value area high, value area low, high volume nodes, and so on and so on? Well, the practical application of volume profile comes down to helping you better understand the market context and identify levels from which you can trade with a higher probability of success. Because each of the components of volume profile can help you to identify the price direction and the price reversal even before the price starts moving. So we cannot predict the market, but we can analyze with a very high probability what is going to happen even before it starts happening. And this is what I love the volume profile for. Okay? Guys, I have no clue, to be quite honest with you. I do not trade the ICT concepts. And the only things that I trade is the actual price movement and the market auction, which applies to every single market. So I would say if you call the fancy name is the FVG is a fancy name. And the low volume node, that's a name which actually directly refers to the market. But yeah, we can talk about the ICT another time because that's a whole different story. Nonetheless, let's summarize the key principles of how to apply volume profile in trading. And we will build our practical trading methods on this specific foundation, which we will be discussing in just a couple of minutes from now. First things first, finding support and resistance. The level with high volume, which are the point of control and high volume nodes or volume extremes, often act as support to resistance levels. If price approaches such a level from above or below, there is a very high probability that the battle will occur there, and the previous traders who were trading there are going to be defending these levels. Also, because of the high volume nodes or extremes, there is a very high probability that the limit orders are left. The limit orders will be acting as a wall, stopping the price. So you can expect a bounce or at least a slowdown in movement when the price approaches the high volume node or the point of control. Knowing these levels in advance prepares you to expect reaction in the zones, and you can build either the ID for an entry point or the exit point at the next high volume zone. Second, identify balance or imbalance. By looking at the profile, you can determine whether the market is currently balanced or not. And for example, if the price is trading inside the value area, between the value area high and value area low, it suggests that the market is essentially in the balance and the movement is more likely to be sideways. This is a point where buyers and sellers agree on a certain price, that the price is currently fair, and you can expect bouncing from the edges of the value area high and value area low towards the center of the range. However, if the price breaks beyond the value area high or beyond the value area low, this is a sign of imbalance. There either the trend movement that starts happening into a new price zone, or a false breakout has occurred. And in both cases, this is a very valuable information for the trader's tactics and your potential entry points and exit points. we're going to cover one trading method, which is going to be relying on the value area high, value area low, and how the price responds when it comes there, just in a couple of minutes from now. Thirdly, finding the best levels for take profit and stop loss placement. Now, this is a question that I get very, very often. I can't even tell you how often do I usually get this question. How do you place the stop loss or take profit levels? Because a lot of people have difficulties placing the stop loss because the price just takes the stop loss and goes in your direction. Or it misses your take profit just with a couple of ticks and reverses back to the loss. If you have ever experienced this, can you please put one in the chat? Because I did, right? If you have ever experienced the price just reversing right in front of your take profit, or taking your stop loss and going back into the loss, like I've had it many times. Peter, Trevor, I'm with you. Timo, Oli, Swirls, yes, I see you. I also had it before, and then I discovered the volume profile, and when I understood how the market auction works, it helped me to start placing my stop loss behind the specific zones which are supposed to hold the price. And if the price breaks them, it would invalidate completely my whole idea. Because the stop loss, the idea of the stop loss placement is to make sure that it is protecting your trade. So at the point of the price reaching the stop loss, your ID should be completely invalid. So there should be a minimal possible chance of the price continuing to go in a direction. It should be the point where if the price takes your stop loss, you should get out, because the price is most likely not going to go in a direction anymore. So using the volume profile, you can also identify the zones, learn how to place stop loss, and find out the best take profit areas where the price can still reach it, but also maximizing the potential of every single trade that you take. And I'm going to cover it later on the live charts. I'm going to show you how I use volume profile to place my take profit and stop loss zones. Okay, so fourth, you can build the frame of the future price movement. Now, this is something that I covered before, that actually volume profile can help you to essentially understand the direction of the price before the price even starts moving. So you can see where the market is balanced and where the impulse begins, and we can analyze from which levels a reaction is very likely, in which direction the market is more likely to move before the price makes this move. This is the power of the volume. We can also apply the value area and high volume accumulation zones to find both trend entries, trend following trades, and reversal entries too. For example, if the price again moves above the value area and value area high, and it exits the area of the balance, analyzing direction, you can buy in the trend direction when you see the impulse just get started. So we're going to talk about it. And last one, analyzing direction using low volume zones, which some of you call the vacuum, FVG, whatever you guys call it. The point is the low volume zone can help you to understand where the price is going to go next. Because again, it often acts like a black hole or like a vacuum, like a magnet in the market that pulls the price towards it. So if the price is below the low volume zone, you can expect the upwards pullback to fill in this gap, this vacuum, this low volume zone, and vice versa. If the price is above such a zone, you can expect the price to pull back first before eventually continuing to go up. However, it is very important. I should not, I personally do not use the low volume zone as a reversal point. The very idea of vacuum or magnet is that there was a very little volume. This is why it is called the low volume zone, as you may probably guessed already, meaning there is a very little amount of money and very little interest to the price at this very area. So in other words, there is nothing for the price to react to. There is no reason for the price to reverse at this level, and there is a very unlikely chance for you to see a reaction there. So therefore, vacuums, low volume zones, vacuums, magnets, however you want to call it, should not be used as an entry point. It can be used as a very powerful tool to identify the direction of this price, but not to find the entry point for neither the trend continuation or the price reversal. Additionally to those 5, volume profile works great in combination with other tools, like, for example, support and resistance levels from the technical analysis, or if there's a clear level, for example, in the chart that matches with high volume node, this is a double confirmation and makes the level very significant. Or in, for example, combination with delta indicator, or it's even working with a combination of the vertical volume that we talked about last week. Okay, so if you see the volume profile aligning and giving you the same exact signal for the direction of the price as the vertical volume indicator, this is a double or triple confirmation if you also use a footprint on top of it. So you can combine these things that we cover every single week and create a very powerful trading system for yourself. And by the way, in the end of the series of webinars, in the end of our marathon, I'm going to be telling you and showing you how you can combine these methods in a very powerful trading decision-making system, very powerful trading strategy. That's why make sure to stay till the end, not only of this very webinar, but keep watching our marathons, because eventually in the end of our 7 marathons, 6 weeks, you will be able to find yourself a working, high probable trading system. And I'm here to help you as much as I can. Okay? So let's talk about 3 methods using the volume profile. Let's move on from theory to practice. We're going to break down 3 trading methods based on horizontal volumes and key profile zones. And for each method, we are going to be also talking about the entry confirmations, conditions, what we consider confirmation for the trade. And I'm going to briefly explain the logic behind each and every approach. Once again, if you have any questions, please make sure that you drop them in the chat. And I'm going to come back to them in the end of our webinar when we will be covering the Q&A session. Okay, ready? Let's get started. The method number 1, which is in front of you on the screen, is the trading from the point of control level itself. We essentially wait for the price to approach the point of control over significant profile. For example, most often, traders use the point of control of the previous day or the previous trading session, if you are trading intraday, or the point of control of the consolidation on the high time frame. You can also adjust it to your trading method and to your trading style, and for example, apply volume profile of the weekly time frame or the monthly time frame if you are a swing trader. You can also go lower. And if you are a fast scalper and you prefer the fast-paced trading, you can use a volume profile of 1 hour chart. Let's say you are trading on 5 minutes and your volume profile is set to 1 hour period. But nonetheless, in the example in front of you, you see how the price reacted to the point of control of the previous day. So each and every point of control that you see on your chart, now I hidden the volume profile histogram itself to not distract you. So there is no volume profile histogram, there is only the point of control. Let me remind you again, the point of control is a maximum volume level that was traded during 23 trading hours in this specific case, because this is a daily point of control. Okay? So what is very important here is that I use the point of control of the day to enter the trade only when the previous day is over. I want to repeat it again. I use the point of control of the day for my trading decisions only when the trading day is over. Meaning that the point of control which is formed today, right now on the 29th of April, okay, I will start considering as an entry point only from tomorrow. The reason for it is that during today, the volume of this day is still being formed. Obviously, the trading session continues. More traders are entering trades and positions, closing the previous positions, and the volume is changing, which means that the point of control might switch location, and then my whole entry point will be completely invalid. When the trading day is over, the point of control of the past day has a fixed location and does not move anymore. So the point of control which has been formed today, I'm going to be starting consider for the entry point when the market reopens after the overnight clearing. I hope this makes sense. If it doesn't, or you have any questions left, the chat is in front of you. Please use it. I'm here to help. So the algorithm of this method number one is essentially this. First, you wait for the trading day to finish and for the trading session to close off. Secondly, you find the point of control of the previous day, which others draws for you. So you just need to see it. Pretty much it's done for you. You just find it, you pay attention to it. 3, you check if the price is now higher or lower than the point of control of the previous day. Now, this is essential because the point of control is the maximum traded volume, which means that majority of the orders during the previous 23 trading hours were executed exactly at this very level. If the price is higher, what does it mean? It means that during the past 23 hours, the majority of traders were buying at this very moment, and eventually the price moved up. This level of the point of control will now be acting as a support. So if the price is higher than the point of control when the trading day is over, it shows the bullish priority and the control of buyers at this very level. When the price returns to the point of control of the day from the upside, so it acts as a support, the price returns to this from the upside, you can expect the price to react, and you can use this level as an entry point for your long position. This is example number 1, which is in front of you on the chart, the long entry from the daily point of control. And Dave is saying that the same theory can be applied to weekly and monthly exactly. The same market auction theory, and this is the whole point of the webinars. Once you know the market auction, how the market functions, how the orders are distributed, what moves the price, what stops the price, when you understand this, I feel like you start seeing the market differently. You start understanding what is happening instead of trying to predict, instead of trying to guess, and it makes it easier to make confident and better trading decisions. So yes, Dave, it can be applied for the monthly, weekly, or even smaller time frames, like for example, hourly, 15 minutes, and so on and so on. Now, accordingly, if the price is below the point of control of the day when the day is over, it shows a bearish momentum and the seller's control over this very price level. Why? Because again, this is a maximum level of volume. If the price went below it, it means that majority of traders were executing sell orders at this very level. So if the price returns to test the point of control of the day, it may act as a resistance. It can be used for the entry point for your short position. An example of 2 and 3 in front of you on the chart represent exactly this situation. Okay? Okay, while we are here, I'm going to cover this question. The point of control cannot move when your period that you look at is over. This is why a couple of minutes ago I said I trade daily point of control only when the day is over, because obviously if the trading day is over, the daily point of control cannot move anymore. Of course, if you are trading today's day and you are looking at this very daily point of control, that point of control can move when the volumes get distributed. So you trade the daily point of control when the day is over. In the same way, you trade from the monthly point of control when the month is over. You trade from the weekly point of control when the previous week is over. Okay, because during the week or during the day, during the month of this very point of control formation, point of control can still move. Okay, so this is method number 2, and now we also don't really need to rush into the trade just because the price touches the point of control level. We can, if we want to, wait for the reaction. At the point of control level, there should be signs that large players are defending this level. What may it look like? Well, it might look like, for example, a slowdown in the price drop or rise as it approaches a point of control, and the appearance of the reversal candle at this level. Look at the example number 1 and look at this very long wick that touches the point of control. You could have entered from the point of control of the previous day as a buy limit order, but you could also waited for this confirmation for the long wick to touch the point of control or to barely touch it, and then enter with a buy by market order. Example number 3 also represents this situation. You could place your sell limit order a couple of ticks below the previous point of control of the day, or you could have waited for the price to touch it to start dropping and enter as a sell by market order when you see the confirmation that the big sellers started to defend the level when the price returned back to it. Okay, so you can also use, for example, delta divergence. So a large negative delta at the point of control, but for example, the price does not fall further. This is a sign that sellers are exhausted. You can also use a combination of footprint that we talked about in the previous webinars. You can also combine it with vertical volume methods that we talked about in previous webinars. So essentially, the combination of different factors indicating the point of control is holding the price. This is everything you need. You can use footprint, you can use delta, you can use vertical volume. You can use a price action and candles as long as you see the price is reacting to this very level. This is your confirmation. And once such confirmation appears, we can enter a position in the direction of the bounce off from the point of control. The logic behind this method is very simple. I'm going to cover it one more time. We're going to move to the method number 2 in a couple of seconds. So the point of control is a maximum volume. It's a center of gravity. It's a center of the biggest amount of money traded there over the period that you chose, in this case, a day. Large players have accumulated big positions there, and imagine what a big player was doing, buying or selling gradually, building a position around this level, forming a huge position that is now opened. When the price moves away from the point of control, it can be that in large players' interest to bring it closer to their average price, to fill in the rest of the orders. But then they're going to be defending this level for the price going further, because otherwise their orders would be in the drawdown. So they're going to be defending their most adventurous entry level. And by trading off the point of control, we are essentially trying to align yourself with the big money that is trading in the market at the point where previously showed the most activity. From a practical standpoint, you can place a tight stop loss beyond the high volume node. Okay, so I personally always hide my stop loss behind the high volume nodes, because again, the logic is that the price should hold the high volume node. And if the price doesn't hold it and if it breaks through it, then my trade is invalidated. Okay, that was the method number 1. Let's talk about the method number 2. Method number 2 is trading from the value area boundaries, value area high and value area low. In this method, we focus on the boundaries of the value area. Most often, we take the profile of the previous day or other significant period and mark it as a value area high and value area low, which ATAS does automatically for you. So you can see the screenshot from my ATAS platform, and you can see the value area high and value area low that are marked up automatically. I don't need to do anything. I just need to see it and make my decision. For this example, we'll stick to the same period, the daily value area high and daily value area low. We plan to trade when price reaches one of these boundaries. However, for this method, we do not need to wait until day is over. Okay, we do not need to wait until day is over. We can trade from value area high or value area low of the same day. You see on the screenshot that it works very well when the market is ranging. Value area high and value area low will give you great entry points within the consolidation and confirm a market logic instead of blindly trading from resistance or support levels. So you can see multiple short entries from daily value area high as the higher boundary of the range, and long entry from daily value area low as a lower boundary of the range. But that's not all. You can also use value area high or value area low to identify when the range is over and market starts moving. For example, as in this chart, when the market spends the whole day in their balance, so you see that it went up, down, above, went back down, and by the end of the trading session, which is at this point it was 7 p.m. in Europe, so that was almost the end of the trading day, the price rises and breaks the upper boundary of the value area high of this very range, of this very trading day. Conditions are ideal if, when retesting back the value area high, there is no strong bearish impulse. So the drop is slowing down, and this increases the chance of an upward continuation, and as the value area high can serve as a buy entry point. Similarly to the value area low, if, for example, the price would drop below the lower boundary of the value area low of the day without any heavy buying pressure, we wait for the potential reversal and the sell from the value area low, which the price broke previously. As in this example, you see that the price broke through. Let me bring this closer. Like this, the price broke through, and you see that within one candle, it came back and retested the value area high and created the long wick, retesting the value area high. That was your confirmation that buyers took control and this level is protected by buyers. So the price exited the balance zone and now starts the actual upwards movement. So I'm going to bring myself back as well. So this is your confirmation that the price has definitely started the move to the upside when it exits the balance zone and it retests this balance zone but doesn't go below it anymore. After this long weak candle was created, you could have made a decision to buy market for the continuation of the upwards movement. But just like with point of control, you can wait for signals that the boundary is holding, like, for example, the candle with a very long wick to the downside. You can also use, for example, the footprint on the breakout. So the breakout candle, you want to see high volume footprint inside of the breakout candle. And you want to see the bright green footprint on the retest of the high value area high as well. On the other hand, if the price would break below the value area low, you would want to see the high volume in the breakout candle, and you would want to see their high, like their red footprint on the candle that retests the value area low as well. So That is also the combination of different confirmations. So your target can be set at least to the next value area high or point of control if there is something above or below. Or you can use the footprint confirmations as a reversal that we talked about on the webinar number 2 to exit the market when the momentum in your direction starts slowing down. And the last method before we're going to jump on some charts and we're going to have a look at some examples. Method number 3, combining volume profile and footprint for precise entries. The entries conditions are the following: that this method is, first of all, more advanced because it combines the profile analysis with order flow analysis. But also for those of you who've been attending the previous webinars, up until this moment, it should be understandable and applicable. So you can use a footprint to increase your accuracy of your system, because obviously none of the systems that you trade will ever have 100% probability. I need you to know this, but you can increase your probability and the win rate by using, for example, footprint and looking at the activity of market orders at the moment you make a trading decision. First, you proceed as per usual. You find an interesting level for using volume profile. In this case, we're going to be using the high volume node. The gray line on the bottom, I was trying to fit it on the screenshot, but I'm going to show it to you in practice. It's going to be better. The gray zone on the bottom is the volume extreme, is a high volume node of the previous trading day, of the same trading day actually. So you can see the high volume node. The price retested it once already, went up, retesting it back, and you can see that this very level is the high volume node that the price has been reacting and holding. In other words, this is your strong support zone. So the condition of potential trade using this method is the following: the price approaches the high volume node, you bring up the footprint to get a confirmation, and you wait for the confirmation from the webinar number 2 to enter the trade. In this exact thing, you want to see what exactly is happening at the selected level at the moment of contact of the price with the high volume node. And this example, for a long entry, for a buy entry from the long support, you want to see the green bright delta appearing. So this is an ideal scenario. You see the price touched it before and bounced up quickly. You see the price coming back, and at the moment it touches the high volume node, the bright green cluster appears, and the next candle closes above this bright green cluster. This is information from the webinar number 2, so if you did not rewatch it, if you just signed up and joining it us right now for the first time, you might want to go back and rewatch the previous 3 webinars to make sure that you get it. But once you rewatch it, I'm sure that you will be able to understand it clearly. So in this example that you see in front of you, the confirmation is quite obvious. So the big money was defending the level. Someone was entering aggressive buy by market positions at the moment of contact of the price and high volume node. If the confirmation is not obvious and you see the footprint is empty when the price retests this level, it means that big market players have no interest at that very zone, and it's better to stop and hold from entering the trade. The logic behind the combination of footprint and volume profile is very simple. Volume profile gives you a context and the point of where reversal or acceleration might happen. And footprint shows you whether it's actually happening. Essentially, we first define where the potential entry can happen. So you are defining the zone. For example, hey, here the big players should be defending if they are present in the first place. And then you look at the footprint to see if the big players are actually there. If yes, you join them. This combination can significantly increase the probability of your success into the trade because it filters out the false reaction to any level. Like, I really love Footprint, and this is why we had the webinar number 2, because it helps you to trade what you see and not what you think. Once again, we want to trade what we see and not what we think. I don't want to think that the price will react somewhere. I want to see the price reaction and I want to trade this reaction. Does it make sense? Can you let me know in the chat? Does it make sense? So when you see those tools aligning both volume profile, vertical volume, and footprint, or at least 2 of those 3, it creates a perfect sniper entry where you can place a very tight stop and pretty much get a really good risk to reward ratio. You can use it for minimal risk and very high precision for entry. Of course, method number 3 requires some experience in reading clusters, and we covered it throughout in the last webinar. And the bonus is that the next week we're going to talk about order flow, and we're going to cover more examples on how you can use footprint and some methods that have a footprint as a base to find entry points. And the next webinar number 5, you can also use as confirmation to this webinar. So make sure you attend, okay? So again, I recommend personally that we first identify levels using volume profile because it gives us a frame of movement. It shows you, okay, here, here, and here, the price might react. From volume to volume, the price most likely is going to go. And then I used to go to footprint and I confirm, hey, is it actually happening? Yes, I enter the trade. No, I stay away and wait for my confirmation. Once again, I trade from high volume to high volume, and all 3 previous setups are based on this. Muhammad, actually in the previous webinars I gave, in the webinar number 1 and webinar number 2, I gave templates which you could download and export in your Atas platform. So this webinar, I will also give you the template that you can download. After this webinar is over, in the next 30 minutes, you could re-enter the same link. And in the description to this video, there will be a link to download the template, which you can use in your Atas platform. So the only things that you need to do is you need to go to the Atas website, download Atas platform, install it, and then you can go save this file and import this file into your Atas. And you're going to have exactly same charts as I have. It's going to be set up within 3 clicks. So you don't actually need to do anything. You can just set up the same things that I have, just download it, apply it, and you are ready to go. Mohammed, let me know if this helps. Przemek, dziękuję bardzo, bardzo mi miło to słyszeć, czytać w tym przypadku. Okay, so let's first go into some examples on the charts, and then we're going to have the Q&A session. I'm going to come back to all the questions that you just posted in the chat. I see them all in all the languages, and I'm going to do my best to answer all of them, okay? So let's first go and explore some charts. I'm going to show you real examples on how I apply it, and that is going to be better because I can actually help you to, there we go. I can actually help you to answer your questions. So let's have a look at it. The example in front of you is literally the one that I brought up, and the reason you can see it in front is because I want you to see how the volumes were actually distributed. So this gray zone, as I mentioned before, if you zoom it out, you will see that this was a high volume node on the same trading day. So you see that the volume was formed here, the price exited this high volume node, and it's been using it as a support multiple times. Now, this is not enough for me because obviously I don't know if the price will continue to bounce from here or is it going to break through it. So before I make my decision, I open Footprint and I see, is there an activity of buyers or sellers? I can see an activity of buyers already here. So the green bright delta when the price touches the previous high volume node. And this is the reaction that I want. I want to see the aggressive buyers entering their position. And then I see even better confirmation, even brighter green delta when the price touches the high volume node, which is an extra confirmation for me. When the price keeps going, what I see is this cluster. I see that sellers were trying to enter the trades, but buyers took over. And I see the stacked clusters, bottom red and top green, and the price continues to go up. As a candle, it shows me the bullish candle. So the sellers were trying to enter the trade for a sell from the previous resistance, but you see the empty footprints the previous 2 times the price touches the zone. So this is a breakout footprint. This confirms that, hey, I can keep holding my buy order. So this was a trade that we could potentially take here. Now let's have a look at another, and this template of volume profile and footprint. Okay, I'm gonna add to the description of this video so you can download it, and I'm gonna also add the value areas and point of control here so you can clearly see the combination. Now let's have a look at this scenario. Look at this. The high volume node is on the bottom, you see, and I want to know, should I enter the trade or not when the price touches this high volume node? So you clearly see the volume was accumulated. The price never came here before. So should I enter or should I not enter the trade here? Well, let's have a look at it. I'm going to highlight the zone. Here it is. So we zoom in and we have a look at the footprint. This is something that I didn't even prepare. I'm doing it with you to show you how it reacts. The price goes down. We have a red footprint. We have majority of clusters are red, which means we had more bids than asks, bearish candle. We had a mixed footprint. We have red, but also the bright green cluster appearing. We have another attempt of sellers to push through. And then the next candle with a bright green delta closes above this bright green delta and retests the previous high volume node. So when this candle closes, I can enter for a buy and I can still ride all of this movement to the upside until I see the confirmation of the market reversal, which is this very footprint, 2 red footprints here, and we may exit the trade. But what I like the most is actually point of control. And look at this very situation. This is the previous days on the mini S&P 500, so it's just a couple of days ago, like yesterday, this week. So we see that the trading day is over, the market opens, and the price retests it again, and go up. So there was a potential entry for a buy. Here, the price comes back, the day was not over, so we don't enter the trade. The trading day was over here. So here, when the new trading day is over and the price appears below the point of control of the previous day, I can enter a trade for a sell. Okay, let's go back. Here, that was a gap. Thank you, Trump. So we see here, the day is closing and the price retests the point of control. You can also open the footprint, okay, for example, and find confirmation. So you can combine it with a volume profile, but you can enter a buy and the price still went up for another 95 ticks, which is 900, which is more than $1,000 for a mini S&P 500 for one contract. Okay. Now, what is very important is I want you to know that I consider when the price comes close to the point of control, I already consider as a reaction. Now, on the previous webinars, I mentioned that we trade from one volume 2 times, one time for a sell, one time for a buy. This will also apply here. And I want you to make a note on it. So we apply this as well. When we see the point of control, I enter from the same point of control only one time for a buy, one time for a sell. I don't enter more times from the same point of control because the more times the price retests the same level, the higher is the chance that the price is going to reverse and break through it. Why? Because the more times the price retests one volume, the less volume is left there to defend this level. Okay, so I do not enter from point of control here, for example, if it was already tested here. I don't do this. This is very important. Let me go ahead and let me add here, and let me change it to the weekly, because we did have some questions about different time frames. So if we go up here, the instrument that you see in front of you is called the market profile and TPO. Again, you will be able to download this very template, so you don't need to set it up now. You can go ahead and download it later on from here. And I'm going to go ahead and change the value areas to lines. Actually, let's do it as an area and make it slightly darker. And I'm going to change to the different time frame. So right now I have the 30-minute time frame, S&P 500, and the volume profile that you see in front of you is based on the weekly. So what we see here is something I want to show you. This is a frame of the past price movement. Each high volume zone is a potential support level for the price. You have the high volume zone. Let me highlight it in different. Here, we have the high volume zone here. That's a support level. The price comes back to it, we can take a buy. If the price would come back to this zone, we could also take a buy. Imagine if the price drops. I'm not saying it would, but if the price drops, we can take a buy here. We can also take a buy where? Here. Oops. From the high volume node and the value area low of the previous week. So this is what I meant when I was saying building the price, the frame of the price movement, because it can help you to identify where you're going to be entering the trades from before the drop has even started. So right now the price is in balance because it is around the same value area and it is inside of the high volume zone. I do not trade when the price is inside of the high volume zone. Just like we were talking on the previous webinar about the vertical volume, we want to see the price exiting the volume zone first, creating an air, a space between the price and the volume, and then coming back to it. So for example, what can we do now? Is that the price is going up, for example, here, and you see the price here, and you see the air, the space, the background you can see in front of your in between your price and the volume profile, and then the price comes back and I can take a buy. While the price is consolidating here, I'm not interested in taking a buy because the price is in balance. If it is in balance, it means that buyers and sellers agree on the current price and consider it fair. So why would I enter the trade if buyers and sellers consider it fair? If the price starts moving up and then it comes back to the high volume node or the point of control, I'm going to take a buy because this movement already started and buyers showed the strength, the momentum. Okay, you come back, price comes back, retest it, we can take a buy. On the other hand, what can we do? We can take a sell if the price goes down, breaks down. I can take a sell. Let me rebuild it. We can take the breaks down. It has a space between the price and the high volume node. Then it comes back. We can take a sell and we can use the previous zones here to buy S&P 500. Can you see how before the price even exited the consolidation, before the price even exited the balance zone, you already know what you're going to be doing? Can you see the power of volume profile? Like, I can't stress it enough. I really love it because you don't even need to wait for the price to start moving. You can already build your ID, what you're going to be doing which gives you more confidence. It gives you more peace. You wake up in the morning, you plan it out, and you just wait for the price to reach your zone. You don't chase the price anymore. You wait for the price to come back to you, to your zones, and then you act. You don't chase, you don't revenge trade, you don't try to catch the price, and you're not worried if you missed an entry, because if you missed your original entry, guess what? You can use a footprint to enter it a little further and still get a good trade. So everything we've been discussing in the previous webinars is actually extremely helpful. Exactly. Yes. Fantastic. So let me answer your questions. I'm going to keep the chart open because a lot of your questions are related to the chart. So we're going to be coming back to this. What is asking, do you use low volume nodes in your trading strategy? Sometimes the price has reversal from them. Sometimes it has reversal, but again, as I said before, the whole idea of the low volume node is that there was very little volume and very little interest to the market at this very zone. So I don't use this zone as an entry point. But what I can use the low volume zone as, like for example here, look, the price created a gap. A gap by default is low volume zone because, well, nothing happened there. There was no trading at this very zone, right? So you can see that there is a gap and you can expect the price to still come back to it. So although the price went up, you knew that there is still a very high chance the price is going to go down to at least fill in part of this gap. Would I enter here? Definitely not. I would not enter here. Would I be entering for a sell, for example, from the previous high volume node, from this zone? Let me show you. This was a previous week. This was a previous high volume zone. Look at this. The price created high volume zone. This zone is now a resistance for the price. Price goes up. Would I be looking for a sell here towards the low volume zone? Yes. Why? Because the high volume zone is your key point of the price reversal and reaction. Your low volume zone is a magnet. It attracts the price. So I don't use it as an entry point because I find it quite dangerous. I use it as the directional bias for the price. Hope it answers your question. Simple equals success. Yes, I believe so as well. Yes, I do use the footprint. Exactly. You can combine it with a footprint and get the sniper entries. Alexander, their calls are recorded. So since you're here, you've been registered for the webinars and you will be able to rewatch the same call and also download the template when the webinar is over by the same link on your email. So you got an email in your link, click the same email, the same link, and you will be able to rewatch the same webinar and repeat this information. Alexander is asking, I trade on 1 minute chart on ES. Do I use a 3 or 5 minute horizontal volume? So I would use the 15-minute horizontal volume. So Alexander, what I would do is I would go to market profile. I would download the template that I will send and change the period volume mode. You can change the same, the period from weekly to 15 minutes or 30 minutes. I'm going to explain you why, because 5-minute volume is too small for the price to hold. 15-minute is, I think, appropriate for you if you trade on 1 minute to catch this movement. And I would trade from high volume node to high volume node, from high volume node to high volume node on 15-minute time frame, but executing entries on 1 minute. Let me know if it makes sense. Is there a way to sell important deltas or imbalances in the main candle view instead of zooming to the footprint view? Yes, you can. So if you want to have a look at the candles, like for example, like this, and you don't want to zoom in others, you have this zoom in magnifier tool. So you can just check how the price is reacting. without zooming in. So you can magnify the area of you are interested in and see the deltas appearing there and how the price reacts and make a decision, which I find extremely, extremely helpful personally. I don't use Timo. Let's say it like this: each and every high volume node can act as a resistance and as a support, depending if the price is below or above the zone. If the price is, let's go back. If the price is above now this high volume zone, this high volume node, and above this high volume node, this means I'm going to be looking for a buy and it can act as a support. If the price will break through and it will be below this high volume node will act as a resistance and I'm going to be looking for a sell from the zone. So each of the zones can act as a support and as a resistance, depending where the price is in relationship to the high volume node. In this case, if the price breaks above this zone, we're going to go for a buy and it can act as a support. If the price breaks below, we can go for a sell and this zone will act as a resistance. Make sense? I am going for at least 1 to 2 and then, but my entry point, when the moment I enter, it doesn't define my final risk to reward because I add up to my winning positions using footprint. So if you go to the webinar number 2, I use some of these methods that I discussed in the webinar number 2 to enter again in my winning trade. So if I'm already in a buy and I get bullish bright green deltas in a bullish candle, I'm going to be entering in a buy again. So I'm going to be adding up to my winning trade, which helps me to maximize my risk to reward in the end when the trade is closed. So I can even enter 1 to 1, but I'm going to get 1 to 3. I can enter 1 to 2 and I can get 1 to 5 by adding up to my winning trades. Now, very important is that I do not enter losing, like I do not add up to losing trades. I only add up to the winning trades. Yes, exactly. You can use exactly the same setups and principles for different markets. You can use it for trading stocks as well, other assets. You can trade cryptocurrency futures on Aras platform. Like you can trade so many things, so many different assets. Okay, and you can apply the same logic and the same methods for all of them because the market auction and how the price is distributed and reacts to volume is the same. Now, different markets have different volatility, so you will need to adjust your stop loss and take profit placement based on the volatility of your specific asset, but it is the same method, yes, that you can use for the stocks or other assets that you trade. Paul, I do not take it in the account. I trade US stock index futures on the London session. I trade gold and silver futures on the London session. So I do not take in the account electronic or regular trading hours. No, my favorite, I trade mostly euro, pound, silver, gold. I traded oil before, but now I switched it to mini S&P 500 because of how oil reacted. So I only trade a few assets overall. Let me see if I did miss any questions before. What is your average stop loss? This question needs to be referred to the specific asset because different assets have different volatility and different stop loss. For example, if I trade euro or pound, then my average stop loss will be approximately 20 to 30 ticks. Whereas if I trade, for example, a mini S&P 500, my average stop loss will be approximately 60 ticks. I can speak several languages. What do you make? When do you make to open the position? The decision to open the position when I see the confirmation from my footprint chart. So I use a footprint to confirm my entries. Cumulative volume, delta, and open interest are great confirmations as well. And if you use them, you can also combine them with the volume profile. I completely agree with that. This specific setup with a high volume nodes, point of control, and a value area high, value area low, I use for every asset. Okay, this we already answered. Let me see. Dmitry is asking if you can use the value area high, value area low the previous days today. You can, but I would take the value area high and value area low of weekly and monthly. Дмитро, я би використовувала недільні і місячні value area high, value area low, замість того, щоб використовувати попередніх днів value area high, value area low. Тобто я в своїй торгівлі, в своєму трейдингу опираюся о вищі таймфрейми і о волюм з вищих таймфреймів. Тобто в цьому випадку я би брала value area high, value area low, але вже недільного. And the second question Mitro had is, do you use smart money or volume profile? I don't use smart money. I use a volume profile. I use footprint, order flow. I use several other confirmations and instruments on ADAS to confirm my entries, but they're all based on volume distribution, asks, bids, disbalances, and everything else. So I don't use smart money itself. No. Не використовую smart money. Я використовую ще кілька різних інструментів, які теж доступні в Атасі, але всі вони опираються о order flow, дистриб'юція ask bid, імбаланси, дисбаланси між ask bid. І саме на цьому полягає моя торгівля, мій трейдинг. Okay, so let me see. What is a good pair for beginners? I'm going to ask a couple of more questions and we're going to round it off, but don't worry if your question is not answered. We're going to come back to it next week. So what is a good pair for beginner? Any good pair that you are profitable with. My opinion is very simple. Get one pair and be really good in trading it. It's like dating. If you date 100 people, well, obviously not, but you cannot learn how they behave. You cannot learn their character. Now, if you date one pair that you trade, one asset that you trade, you can learn their behavior, their volatility, which hours do they move, which hours are your most profitable trades, which hours are your least profitable trades, and you can create the whole powerful trading system. Okay, so I suggest you to choose one asset that you like and be really good, get really good in trading it and knowing it. You need to adjust it to your preference of their trading. If you are a scalper, you will need to bring the period lower to a day, to an hour, even 30 minutes. If you are a swing trader, you will need to bring this template to the high time frame, weekly, monthly, perhaps. The volume profile will be already provided, and I'm going to share with you not a template, but the workspace with 3 different charts, which are one for value area high and low trading, one for their high volume nodes, and one for the combination of footprint, high volume nodes, value area high and low, and it's going to be on 5 minutes, and you can choose which one works best for you. You can see how the price reacts. Okay. Thank you so much for all the kind feedback. I really appreciate Timo, Namps, Alexander. Thank you so much. Mohammed, amazing. Thank you so much. I really appreciate every single one of you. I really am happy that you all love it and enjoy it. Thank you so much, Dmitro. Thank you, Timo. Appreciate every single one of you joining, your attention, your feedback, your interaction in the chat. And it's great to see that you are learning and you find the information useful. Please go ahead in 30 minutes from now, re-enter the same link you received on email and download the templates, apply it in your ARAS and check it out. Try applying and combining things we talked about on the webinar number 1, 2, 3, and 4 and see which things work best for you, where you still have questions, and bring these questions to the next webinar. Don't feel shy. The worst question is a question that is not asked, because eventually it will cause a trouble somewhere. So make sure you ask questions and make sure that you are on the next webinar in 1 week here again. Just to recap, we did a pretty great job today here. We discussed what volume profile is in the first place, why and how it highlights the zones of interest for large play. And we learned the 3 base specific methods for applying this knowledge trading. You can customize it, you can combine it with footprint, you can combine it with vertical volume, because you already know about the point of control, value area high, value area low, high volume node, low volume nodes. For beginners, these letters are no longer just random sounds, but the useful information on your chart that you can use for your decision making. We also saw in practice how Profile works together with Footprint and how ARAS implements all of this with a very user-friendly tools. So even if you're a beginner, don't worry. In the template that you will download, it will be ready for you to apply and trade. My main message for you today is please move from theory to practice. Right after today's webinars, download the ARAS platform if you haven't done so yet, install this template in 30 minutes from now, and try looking at your favorite market or your favorite asset through the lens of volume profile, footprint charts, and the vertical volume. So find the point of control of yesterday's session, for example, see how the price reacts, try catching a couple of bounces of the value area high and low on your demo account, and remember, everything that you learn here, all questions that you may have, bring in 1 week from now on the next webinar. With all of that, we'll wrap up today's webinar. Thank you for attending and participation. Next week, we're going to be diving even deeper into order flow setups, which you can combine with today's knowledge as well. I do hope, and I also see and know that it was helpful and useful. Thank you so much for the feedback. I appreciate every single one of you. Atas loves our traders, and we wish you all the success, all the profitable trades, and really great smart analysis. I'll see you in 1 week on the next Tuesday, same time, same place, and wishing you all profitable trading. See you next week.